Mortgage rates are climbing, but why? Well, over the past month, Canadian bond yields have hit their highest level since April of last year. As a direct result, we have seen that fixed interest rates have nudged up at all lenders. Now, since the 5-year fixed rate is by far the most popular in Canada and have been the most discounted, those are the rates that we saw start to increase as February was wrapping up. Coming into the new year, 5-year fixed rates were available at most lenders anywhere from 1.39% to 1.64%. Well, those rates are gone now, but it isn't time to panic. All the reasons that rates were low are still here. Now, like most things, rates overshot the mark while dropping and are now most likely stabilizing. In December, I shared the projections for interest rates in 2021, and I told you that rates would stay low for most of the year. That is still true. Interest rates around 2% are still crazy low and really have never been seen before. Now, I do still expect to see fixed rate mortgages near 2% for most of the year. Springtime often brings rate competition as banks hit the middle of their fiscal year and work hard to hit their annual targets. As of today, we can see 5-year fixed rates as low as 1.74%, but I don't expect that to be around much longer. The majority of 5-year fixed rates are currently sitting between 1.94% and 2.24%. The question people ask is, why are rates coming up? Is there not still a pandemic? Don't rising interest rates mean that there are good things happening in the economy? Sure, well, vaccines are now available and there is light at the end of the tunnel for getting out of this pandemic. And so hopefully the economic harm will be fairly short-lived. In the United States, there is now the expectation of slightly higher inflation than they'd previously been anticipating. And this has put upward pressure on the bond rates, which actually have a major impact on Canadian fixed-rate mortgages. Here in Canada, we don't really know what's going to happen. There's certainly a sentiment that this run-up in bond yields will be temporary. However, nothing ever really stays the same. Nothing ever trends consistently. However, it could be that interest rates as low as 1.49% for a 5-year fixed term are gone forever. But it doesn't mean that rates are going to return right away to that 3% or higher level that we've seen before. Where fixed rates trend close to the bond rates, variable rate mortgages and the retail prime rate is very closely tied to the Bank of Canada overnight rate. This past week, on March 10th, 2021, the Bank of Canada made its second interest rate decision announcement of the year. Now, there was an expectation among some economists that the Bank of Canada would continue to keep its overnight rate the same, but maybe indicate that they were going to start backing off of their other monetary policy of quantitative easing. Now, while the bank did keep its interest rate the same, it did not budge on its current commitment of using quantitative easing to keep interest rates low across the yield curve. This is good news for homebuyers. This is also good news for people who are refinancing debt. And it's also good news for anybody who has an upcoming mortgage renewal. For the first time in a long time, it's time to have a discussion about variable rates. Variable interest rates are still available under 1.5%. If fixed interest rates continue to stay between 2 and 2.5%, there's actually a really good argument to consider the variable rate, with the prime rate not really poised to increase for quite some time. The goal of the Bank of Canada is to keep inflation between 1% and 3%. Now, currently, inflation is kind of at the lower end of that band, closer to that 1%. And while there are some encouraging signals in the economy, the bank noted that there's still a lot of slack in the system and a lot of uncertainty surrounding the virus and the path of economic growth. The bank's concerned about the spread of new variants of COVID-19 and considers that to be one of the largest downside risks to positive economic activity. It could slow things down or add some uncertainty. Employment nationally is still well below pre-pandemic levels. Unemployment in Alberta is expected to hover around 9.5% for most of the year. And this is still quite a bit higher than normal unemployment rates. The bottom line is that the Bank of Canada remains committed to holding its interest rate at a low level until the economic slack is absorbed and the inflation target is sustainably achieved. The Bank of Canada says that this will not happen until sometime in 2023. If you'd like to go over any of this, have a discussion about when you should lock in a rate for a pre-approval, or what to do about your upcoming mortgage renewal, please let me know.